Hello, hello, and welcome to episode 29 of the Capital Spotlight podcast. Your host, Craig McGrother, the Director of Business Development here with Lone Star Capital. Alongside, as always, the man, the myth, the legend, the co-principal and founder of Lone Star Capital, two-time author of over 20,000 books sold, Rob Beardsley. How are you today?
I'm doing great. We just had pizza day in the office, so I've got pizza all over my face and I'm gonna fall asleep, but it's all good. Feeling good.
Exactly. Nothing like a light piece of thick Church Street pizza, right?
Yeah,
Yeah, to
Prince.
go
Yep.
Yeah, to go carbicide on everyone and to have to be sideways for a nap. But hey, we got a jam-packed day today because not only do we have this incredible show we're going to deliver to you, but we also have a special webinar for Aspire. That deal is an incredible deal. If you're a capital raiser, if you're an investor looking to partner with us and learn more about that deal, as it's a 506c, so we can widely talk about it, please let me know. Reach out to me at craig@lscre.com. Additionally, some housekeeping items. This is January 3rd recording. This will be out on January 8th. We'll be in Texas next week, so we're going to Houston and San Antonio. So maybe you might be catching us a little bit late here, but reach out to me if you'd like to potentially meet up in Houston or in San Antonio. We'll be in Houston January 8th and 9th, and then the night of the 9th, we're driving to San Antonio. We'll be in San Antonio looking at Spire, and then the day before at a new acquisition in Houston, but we'll be in San Antonio on January 10th and 11th, leaving midday there. So maybe meet up with us there. Someone else, actually, several people have reached out to me with regards to meeting up and coordinating from listening to our show, which is awesome. We're also going to be having a mixer event in Newport Beach, California. So that will be coming up when? Do you have the date on
February
head?
1st.
February 1st, right after NMHC. Speaking of
Yes.
which, before the Newport event is NMHC. So if you are in fact going to be attending National Multifamily Housing Conference in San Diego, California, let me know. I'm actually very excited for NMHC this year, juxtaposed to last year. Was not a big fan of it, but I think being outside of Vegas will make it more appealing. Also, I feel like we're a little bit more set up with regards to meetings and whatnot, and hopefully it'll be easier to navigate walking through and finding where everyone's going to be located. So I'm looking to hopefully have a more smooth experience there. We also have Race Fest in Phoenix coming up. That is January 20 or February 22nd to 24th. So if you are a capital raising partner, going to be in Phoenix, Arizona a little bit before. I know you mentioned that you'll be there right after your birthday, I imagine, as your birthday is February 15th. You'll be out there hanging out, and we'll be taking folks like Gib to Buck and Ryder. So if you want to get a nice dinner, if you're a capital partner that's looking to raise and partner with us, you know where to find us. Reach out to me at craig@lscre.com. Any other housekeeping items that I may or may not be missing?
Yeah, I mean, what an amazing way to start off the year. We got all these great events planned, some that we're hosting, some that we're attending. And also, one thing you didn't mention is you'll be attending IMN's Laguna event, which is their
Yes.
flagship private capital event. So I'm really excited for you to go to that. That's the first time that anyone from Lone Star will have attended that event. So that's going to be a great experience, I think. I think there's a lot of big players that are going to be there.
Yeah, and it's funny. I think you and I have kind of talked about this, but we've got a very nice staple of capital partners that we're working with right now. And our goal is actually not to go super wide anymore as much per se, but instead of going wide, going very deep. So going deep in regards to the connections that we have and really kind of doubling down and focusing on those people as opposed to, meeting someone, maybe sending them deals one off, and now you're just another person sending them deals. So to really build legitimate relationships is kind of what we're seeking to do here in the new year. So we're trying to travel. We're trying to get everyone's location down to make sure we can send out emails, take people out to dinner. 2024 is the year of intentionality. So we really want to be intentional with our travel, with our workflow, and making sure that we are, really developing and harvesting relationships that last a while. On to the show topics, as we had a long-winded intro there. We're going to be talking about 2021 being a bad investment vintage. It's funny, All In, Freeberg was talking about how 2021 for venture capital was a bad year. And similarly for multifamily, we'll get into the nuances as to why, but 2021 was not the best year for investments in that regard for multifamily. How to get paid for your CapEx. So where is the value to add for value add deals? The residential real estate structure, it seems as if there's a lot of misconceptions regarding that. So I would just like to spell that out real quickly. And then also a mailbox question that someone who listens to the show asked us. We'll get into that question after. And if you do have any questions that you'd like to get answered on the show, please, of course, email me at craig@lscre.com. And once more, if you're looking to partner with us, you're looking to raise equity, for some of our deals and learn more what a structure and a partnership would look like with Lone Star Capital, please reach out to me. Would love to kind of walk you through who we are, what we're doing, and how you could participate in that if you aren't aware of all those things.
Amazing. Let's
Cool.
do it.
Yeah, let's get into it. Without further ado, 2021 being a bad investment vintage. So All In talked about this, venture capital just not doing very well that year. And it's kind of funny, it ringed very true to what kind of happened in 2021 with, just the multifamily housing market, right? So effectively, deals got, the market got really hot, cap rates got very compressed. Raising money was the easiest, but similarly, what happened? A lot of those deals were on bridge and floating rate debt that have maturities in 2023. So maybe you're in the extension year or going through the extension currently, maybe at a 3-year plan, whatever it may be, and you're extending right now and you're figuring out, hey, do I have to extend this? Do I need to capital call or do I need to sell at a loss? Where is the deal truly valued at right now? So those who are kind of in those short-term, debt cycle periods or floating rate debt, not fixed rate debt situations are really going to be struggling right now currently, right? So I thought it was interesting how All In mentioned that it was a bad year for venture capital, but similarly, that was likely when the market was hottest. It was not the best year for multifamily. So would love to have your insights and perspective on that matter.
Yeah, so like you mentioned, David Friedberg on the All In podcast said they were doing their end of year recap and what was the biggest loser of 2023, and he said, well, 2021 investments were the biggest loser of 2023. And that makes a lot of sense. That's not I would say a very controversial opinion, but he was specifically speaking on venture capital, like you said. And so that draws attention to the fact that risk assets, which are stocks, bonds. I mean, really all assets are risk assets, right? Unless you're investing in something that is considered risk-free, which the only thing that's considered risk-free in finance is US Treasury bonds, right? So the important point is risk assets are all correlated because they're all connected to interest rates. So whether you're in the multifamily investment business, venture capital business, private equity, investing into stocks and bonds, you're interest rate sensitive. So you might think that you are really smart or that you have a unique strategy, but unfortunately, by and large, the majority of strategies and asset classes are just an interest rate play. They're just correlated to interest rates. And that doesn't necessarily mean they're bad. It just means you have to be aware of it. And what that implies is that in many cases, when you think you're diversified, you really aren't as diversified as you think, right? If you think that or if you own certain basket of stocks, and then you also own some real estate, and you also invested in venture capital, you might think, oh, well, I'm well diversified. I own all these different strategies and asset classes, but the reality is they all go up when interest rates go down, and they all go down when interest rates go up. So there's I'm not really, I'm kind of rusty on some of these topics, but I used to read some really fascinating papers from this hedge fund, and I'm drawing a blank on the name of the hedge fund, but I'll definitely remember and we can revisit it and talk about it next podcast because I really nerded out on these papers. This guy wrote some really awesome papers, and he talked about how, as far as true exposures and asset classes, you basically have long rates and short rates. And then you can be long volatility and short volatility. And those are pretty much the only asset classes that exist, right? Because it's a myth to think that real estate and stocks, all these different ways to invest are actually different, right? They're all the same, right? You're either long rates or you're short rates. And when I say long, I mean you're basically betting on interest rates going down, or if you're short rates, you're shorting them, which means you're hoping that rates go up. And so a lot of us in our portfolios are long rates. We have benefited over the last 40 years from a secular decline in interest rates. So pretty much everybody who's an investment professional today has only lived through one sort of interest rate environment or economic regime, and that has been of declining rates. And so that means that historically speaking, if you have been if you've owned assets and you've been along any sort of asset, you've seen appreciation, you've seen cap rate compression, or in private equity or in venture capital, you've seen multiple expansion because in those businesses, companies are valued on a multiple of their income. So if you were able to buy a venture capital deal or a private equity deal, and you're able to not even necessarily grow the income of the business. So you're not necessarily making the business a better business. You just benefited from the multiple of the income that values the property expanding, then you are making money and you thought you were a genius. And so this has happened since the 80s, 90s, 2000s, 2010s. And now we've seen it that break down, and we're at what some people argue is an inflection point. And this actually ties really well to some uh, commentary from Howard Marks from his memos. So you can tell because I'm bringing all this stuff up. I did quite a lot of reading over the Christmas break because I did go back and read Howard Marks's most recent memos. And in his most recent one, which I'm a big fan of Howard Marks, he's the founder of Oak Tree Capital. They're a distressed debt investor to their core, but since they've grown and expanded, and then they got bought by Brookfield, which I'm staring out at Brookfield Place right now. So, long story short, Howard Marks, who he's not a guy that puts all these big calls. He doesn't say, I predict the future, or he doesn't put all these calls out there. He's always like, hey, I don't know what the future has in store. We don't invest based on thinking that we know the future. We take what the defense gives us.
Yeah, so he's not emotional and he's not hyperbolic with his decision. He's not irrational. It's very calculated, long-term thinking, and hey, stick to your fundamentals and your guns. Is that what you're kind of painting?
That's exactly who he is, right? He's funny guy, but he's not super loud, shouty. He's not a Peter Schiff guy who's like, "Hey, you need to buy gold because the world's collapsing," right?
Or like Kramer on CNBC, who
Exactly.
literally, if you fade his picks, you'd actually be very, very successful.
Exactly. So Howard Marks, right, he's not one to make these big, big comments, but in his last memo, he said that he thinks that we are at an inflection point where this last 40-year long trend of secularly declining interest rates is over, and now we're moving into a different regime, which is more so not necessarily categorized by the opposite, which would be rising and rising and rising interest rates, but just that rates might be more neutral and flat. So you're not going to benefit from this big cap rate compression and just keep on getting wins and wins and wins. And so for him, and obviously this is convenient for him because they are historically a debt investor, so they make loans. So his argument was that for the next period of time, it's going to be a more beneficial strategy to actually be a lender rather than a borrower because in a period where you see declining rates, it's better to be a borrower because what you're likely to see is your asset to go up in value, the value of your debt eroded by inflation, and so it makes sense to be a borrower. However, if we're in a different environment, right, then it makes more sense to be a lender. Now, those are interesting points, and like I said, he's not one to make these big calls, but if you what that also implies though is that inflation is not an issue. Because if you are a lender, you don't want inflation. Inflation is negative for a lender, much more so than it is for a borrower, right? Because with inflation, you can inflate the value of the debt that you borrowed down. So that is beneficial. So, I mean, there's always these different ways to look at economics and strategies. And so while I find all that stuff to be interesting, and I think it's important to stay on top of economic theory and news and philosophy, I think the best thing you can do is stick to your strategy and stick to what you know. And over long, long periods of time, that will pay off and you'll be successful. So I'm not calling for us to dramatically shift our strategy, although we are always kind of shifting and finding the nuances in the market, which we'll talk about soon about value add strategies, right? But the important thing is to, like I said, stick to what you know and invest for the long term. I look at, for example, one of my uh, I don't want to say idols, what the better word, like role model is MG Properties. All
Yeah,
right.
maybe mentor or somebody you look from afar that maybe don't know, but people you aspire to model your life and business after. I think would be a
Yes,
good way to phrase it.
that's exactly right. So MG Properties, right? Mark Lieberman started that firm, I believe in 1991 or 93 or something like that. So they're over 30 years in the business. And what do? They buy multifamily properties, and that's all they do. And they've just slowly put one foot in front of the other, and they've just done tremendously well. Their track record is incredible, and that is inspiring to me. I don't want to recreate the wheel or jump from strategy to strategy and be an asset class tourist, right? We need to be specialists. We need to drive long-term success. So anyway, that was a very long, winded way of kind of going on and on about uh, kind of a little economic theory update.
Yeah, well, a couple things there I want to unpack. So number one, obviously with lenders, as we know, the upside is very fixed and limited to a certain extent. Like you know that hey, you're gonna make X% on this deal. Hopefully it doesn't get foreclosed on and the deal, exits at a very favorable market. So, the deal is not trading below paper, right? Which we're seeing right now often. But similarly, what you said about basically revenue multiples and whatnot, all in is kind of really talking about right now that businesses that are going to be doing well and going to be thriving in this environment coming up or want cash flow positive to start, right? And are, creating legitimate profit and revenue, right? So anyone can create revenue. I remember Greg Haig, who is huge in the Phoenix market for multifamily or single family home sales. He started 72 Sold, which is a big company that Keller Williams bought. But he said this when, Open Door and Zillow and all these companies were buying homes. Listen, they're just creating revenue. Anyone can create revenue. I could spend $1 billion and create revenue, but can anyone create profit is the real question. And that's what's really important right now. Similarly, as I tie that back to what we're doing, what are we looking for right now more than anything else? We want to have a deal with a really good cap rate with obviously positive leverage. But what's that creating? That's creating cash flow. That's creating more cash on cash. So what we're looking for right now more than anything else is a really solid yield. So we have a preferred return of about 8 or 9%, depending upon your investment range that you're in. And we're getting deals right now with about an 8% cash on cash return, which is incredible because we basically hit our preferred return, which is cumulative compounding just on the cash flow alone. And then anything that we sell after the fact is just upside basically for us and our capital partners and whatnot, and obviously for said investor. But our point of emphasis and likewise venture capital right now are correlated because we are in a higher interest rate environment looking for cash flow positive deals and good yield. So I thought that was something that, as you were mentioning all your points, brought me back to that thought right there that it's all about the yield right now. And for the first time, and why 2021 is bad is because we had cap rates that were sub 5%, debt around that number, or maybe worse, where people did short-term debt to maybe increase the yields of the property, but rents started softening, bumps were not had, and the market they were going to exit in was less than favorable, which is a problem, obviously. But right now, what we're looking to do is have higher cap rates, obviously, in the acquisition that create very positive cash on cash with some obviously enhancement plan one way or another. So I thought that was just an interesting tie-in together that you put, and then got my brain kind of sparked about what kind of we're doing from a strategy perspective, which is, of course, heavier emphasis on the cash on cash play and really solid in core markets where we know that, hey, when the market does turn around and when there will be cap rate compression, these higher end quality deals that are 90s and 2000s vintage assets will get to be the first. If there's cap rate compression, will come there. But if there's less cap rate compression, hey, that's why buying the deals are really important. And buying junk right now is not something that we want to do, because if we have to hold a deal for maybe 5 to 10 years, we'd rather hold the deal that's 90s built, like Beckley Highland and Meritage, or 2000s built that we just closed on, or like Aspire that has an incredible cash on cash profile. I mean, over the whole period of Aspire, which we're looking to close on here soon and raise equity for, that we have a webinar on for today, that'll be probably about a 9 to 10% cash on cash if we hold that years 3, 4, and 5, which is incredible. So those are the amenities and kind of the factors and the profiles of deals that we're looking for right now. And it's just interesting the mirror and matching that we look at. And it's nice because those deals in 2021 with treasuries low, the yield is low, or maybe there's no, cash on cash return at all. So, I think, a lot of capital raising partners I've spoke with and a lot of institutional people we spoke on are really just looking at cash on cash because it's too speculative on the exit cap rate and what that will look like. And, compression sounds nice. We all look for it. We all strive for it, but it's not a guarantee. That's more of just, market dependent as to where your exit is, right?
Yeah, it's actually really funny. So the least knowable variable in your underwriting is the exit cap rate.
And
It's the
that's the most
least.
important factor, frankly, like, because that will
Yes.
decide where the property's value will actually be. Is that like,
Right.
and it's so funny when people look at these huge deals with massive IRRs and equity multiples, they could have bogus numbers. Because if we want to put every single deal at a exit four cap, then every deal is going to be a 3x equity multiple. You can put whatever you want in there, but that's not really, something that is dependable necessarily, because you have no control of that. But what do have control of? Your debt and your cap rate and your cash on cash, right? And your value add enhancement plan.
Much more so, yes. So yeah, it's a tough thing to really hang your hat on. But see what happened in 2021, if we'll continue to pick on that year, is people got really aggressive. And so when times are aggressive, risk leaves the market, or more accurately, leaves the brains of people in the market, right? People stop thinking about risk and they think about greed instead of fear,
Well,
right?
they
So
get FOMO. It's herd mentality. It's a FOMO mentality where all my friends are investing. All these deals have done so well. As Robert Kiyosaki says in Rich Dad Poor Dad, which I just re-listened to, when the headline and people have made money is on the front page of the news and you can get into is when you need to find a new investment and the deal is too late because everyone else is there and the hot money is going to be in, which will just wipe out gains. It's just the natural cycle of things. So right now, yes, right now is the time to invest and is the time to get greedy.
right, because right now is not the time when your Uber driver is giving you stock advice.
Yeah, they're telling you to sell everything. They're chicken little, as the book would say. They're the sky is falling, nothing's gonna work, doom and gloom, and they're the people that will get wiped out instead of actually building legitimate wealth.
Yes, very true. So when risk isn't on top of people's minds, they're not so worried about that exit cap rate as guess, right? They're like, oh yeah, the exit cap, of course that will stay low. Of course we'll make a big return. No big deal. So the cash flow is not as important. See, but the funny thing is now, and you know this very well, over the last year at least, frankly, the conversations we've been having with savvy investors and institutional capital, and they're saying, well, we have no idea where exit cap rates are going to be in 3 to 5 years. So we're going to use a very conservative number. And what we need
We're gonna
instead,
beat up your underwriting a ton. So we're
yes.
really, really gonna handicap your underwriting. Absolutely, yeah.
And what we're going to look at more closely is cash on cash. And that's
Yeah.
what we're going to rely on to drive our returns. And the
Yeah.
funny thing
Yield on
about that,
cost. Yeah.
yes, the funny thing about that is they didn't know what exit cap rates were going to be 2 years ago either, right? Exit cap rates today are no less knowable than they were 2 years ago. It's just that people now are bringing risk back into their mind and now they're caring about it more. So it's not that we are in necessarily a more uncertain environment, right? If anything, we're in a bit more of a certain environment, right?
I
Because
could agree more. Yeah.
like Chris Mendez said at our conference,
I was gonna say that, but I'm so happy you beat me
yeah,
to
go
it.
you go
Yes.
ahead.
No, yes. So essentially, Chris Mendez with Pearlmark. Shout out Chris Mendez. I doubt you're listening to this, but you are. Hello, and would love to have you on the show and take you out to Carbone and Fort Charles. Whatever you like, we'll take you there. So I hope you're doing great and happy New Year to you. But he was saying at the incredible Lone Star Summit, which will be held for the fourth edition, September 16th in New York City, once more at the World Trade Center. So shout out to that event. If you're looking for a ticket, let us know. But Chris Mendez at our event last year on the equity panel said, what's crazy to me and what's riskier to me was when everyone was throwing money when the market was super hot in 2020 and 2021. I think it's way safer right now considering where, the market's at currently. And I thought that point was so true. And, I want to be very greedy right now. We've talked about this with investments and whatnot, but I want to be incredibly greedy right now and, deploy as much equity in good deals as possible that have very, reasonable assumptions and projections.
So let's talk about what makes a good deal because you mentioned earlier what we're focused on, which are deals with cash on cash, but that's not necessarily true for everyone. There's certainly people out there that are still focused on deals that are not cash on cash focused and they're looking at IRR more so.
Yeah. Well, and real quick too, before we get into that, I just want to think about this thought and be curious to know how you perceive this. And also, I'd be very curious to know. So, if you are listening to the show, we'd love to have your perspective. But I feel as if we're in the market right now where deals are going to do very well and we're going to exit well. But when we know the market's going to be really hot on the exits, that means we have to be very careful on the next acquisition because there's a very good chance that deal might be caught in the middle of the cycle, right? Where, the valuations are changing. So, what are we going to do? And maybe this is something you don't have the answer for right now, but from a strategy perspective, if we do really well, we hit a 2.5 equity multiple on some of these deals coming up, which I think is very realistic. Are we gonna kind of go more conservative when we 1031 exchange from deal A to deal B with longer term debt just to make sure that we can stand it and kind of pitch our investors a longer term mindset with regards to capital preservation and also, hey, we did really well here. Cyclically speaking, if we did well here, there's a chance that we get burnt here on the next deal. So let's make sure that we preserve the capital and we are extremely conservative after we've been very greedy with regards to our impeccable returns there. How do we manage that? And how do we go from deal A to deal B and play the market timing game right, because you're never going to time the market perfectly, but we can all put up strategies that will help best solidify uh, capital preservation, right? So what do you think we're going to be doing when the market gets too hot and there's all these indicators of money coming in and flowing, and our Uber drivers are giving us real estate investing advice?
Yeah, so there's so many things to talk about here. This is a great topic. So one thing that comes to mind is the concept that if you live by the sword, you die by the sword.
Yes.
And if your sword is aggressively flipping deals, you're buying, you're value adding, and you're selling, and you're relying on the continuation of the market such that you can exit quickly and at an attractive valuation, that's great. And that's a way to generate very high returns. And what that strategy is predicated on as well is flexible debt. And it doesn't necessarily have to be bridge debt, but it in a way almost has to be floating, because if you're not floating, you're going to be locking yourself into prepayment penalties, which is going to hurt your ability to churn through deals in a 2 year period, right? And that's flipping, 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 right? And in single family, when you hear of house flippers, right, they flip a house in 6 months to 9 months. But in multifamily, flipping is more like 12 months, 24 months, even 30 months is still kind of like a flip.
Yeah.
So for
Depending on
multifamily,
the scale of, yeah, depending on the scale of units you have, right? To your point.
yeah, and yeah, there's a lot of things at play, but that for big commercial assets, that would still be considered a short-term investment and a flip. And so if you're living by that sword, you're going to most likely generate very high returns. But then what's going to happen is, like you said, you're not going to be able to predict the top. So there's no way to stop that strategy from going over the edge and falling down when the market does turn. Because what's going to happen is, no matter how well you're doing while the cycle is going along, you're flipping, you're flipping, you're flipping. Eventually, you're going to get caught into that next flip, and that next flip is just going to so happen to be when the market crashes, as it always does. And that's when you're going to see losses, because it's very difficult to be positioned in such a way to avoid losses when you're busy flipping deals, right? You're living by the sword and you're dying by the sword. That doesn't mean that on average, if you add up all those good wins and then subtract out the losses when the market turns, you might still average out to a nice return. So I'm not saying it's a bad strategy, but you're going to have to live with the bigger ups and the bigger downs.
I mean, there's a lot of people right now though that are having and or find themselves in deals where they bought on no cash flow and they bought on a bridge cycle and or floating rate debt, and they're about to have all their equity be evaporated because too short of deal cycles. And I feel as if right now you can probably get away with I mean for sure floating rate debt. Bridge might be a little bit too soon, but maybe like a 5 year floater term might be really nice, because I do think either they'll stabilize or kind of trend down. That's what, a lot of reasonable people are forecasting. So I understand that strategy, but I just would rather end up with, a slightly more modest returns versus ever losing any equity. But maybe that's just with where I'm at, knowing that market beta and a force appreciation value add plan over the course of a decade or two will just eventually and always ride up, as opposed to getting too greedy and hitting a 40 IRR here, but then all of a sudden getting capital called or equity evaporation on the next opportunity. It's all for nothing at that point, effectively, right? So the way I kind of think about that is just like anything else, slow and steady wins the race. Now our returns are bigger than what the S&P 500 will be, or what just the typical market appreciation will be due to the natures of the deals that we're buying. So we're sheltered and we'll have higher returns there. But I just think about the fact that I'd rather be safer on not this cycle per se, and where our buyings will be in 2024, 2025, and 2026, but it's after that. It's 2027, 2028, and 2029 and 2030 that I want to be very careful on the structuring of the debt and equity as we, handle what's going to come next after that.
So to answer your question there, let's say right now we're definitely seeing a resetting of the cycle. And so it is very likely that the deals purchased in 2024 will do very well, because they're going to experience the rising tide of the resetting of the cycle and getting going again. But then, like you said, if we do really well and then we sell a deal and then we 1031 exchange into the next one, is it reasonable for us to expect that that new deal that we buy is not gonna, is it reasonable to expect that that's also going to be, quote, early cycle and that we're going to be able to ride it up again and then sell that in 3 to 5 years, again, higher and higher and higher, right? You have to be cognizant of the fact that you might be 1031 exchanging into what could be near to the top of the cycle. And so going back to Howard Marks, he talks about cycles a lot. I mean, he wrote a book called Mastering the Market Cycle. And which is funny coming from a guy who claims to not be able to predict the future and not look to predict the future. And so his philosophy is, yes, you can't predict the future, but you can kind of figure out where you are today, right? You can generally decide, are we at the top of the market or are we at closer to the bottom? So that is relatively knowable. But what you don't know is time, because you can be in the seventh inning, in the eighth inning, and think, oh my gosh, this is late cycle. This is feeling very toppy. But guess what? You can hang out in the eighth inning for years, like we did from 2016 all the way to 2020.
Uh,
And
I
then
was
we
thinking
thought, oh, this is going to be a crash. And then guess what? The Fed inflates. And then we go from 20 to 21 to 22. And then finally, we see the cycle reset, right? So you can't know exactly what year, what's going to happen, but you can roughly know where you are and position yourself accordingly. So, like you said, right now, is perhaps a time where you can actually lean in and take more risk because you think that beta will be higher and so risk will be rewarded more greatly. But then let's say we sell a property in 5 years that we acquire today and it's in a market that feels a little bit more tight. Risk premiums are thin and there's other things in the market that we could see. I mean, you can always look at the classic inversion of the yield curve as a sign of a looming recession, right? And a market top, which we don't need, we can get into the nitty-gritty about that another time or something. But so basically you need to be positioned accordingly. So like you said, right, when you 1031 exchange, you need to exchange into a property and a debt structure that is best positioned to withstand being bought at the top of the cycle. So what would you rather own? And this is rhetorical, semi-rhetorical. What would you rather own at the top of the cycle? Core real estate that's super solid, or would you rather own speculative real estate that is relying on a value plan and for rents to further go up,
in a
right?
secondary and tertiary market.
In a second grade market, exactly. So that's one piece of the puzzle, right? It's the actual property and the strategy. Then the other piece, like you said, is debt. Because if you're going to have to ride a down cycle, you need good debt to be able to ride it out. So what you need lower leverage, better DSCR, and that's really it. It does and term. Term is really good too. But I would say term is even less of an issue than DSCR because at the end of the day, if you and we're seeing this every day because right now we're in the throes of this shaking out of the cycle. And so what we're seeing is people becoming maturity defaulted. And that means their loan is in default because their loan is now due and they can't pay it off. And what's happening? Most of the time, the lender goes, yeah, I'll give you an extension, right? Because a lender is not going to want to foreclose on a property that is performing, right? If the property is not performing, that's when the lender is going to be more so forced to take the property back. And that is obviously, as a borrower, the thing you want to avoid most. So it's more important that you can continue to make payments more so that you have more term on your debt to avoid being maturity default, because I think you can negotiate your way out of that more so. So if I'm looking at debt, I'm definitely looking at the risk factor. Number one being what is the DSCR and your ability to refinance out of that, which last week we covered the refi exit test, which I think is a really, really great way to analyze the risk of a deal. And that is number one, most important when you have a bridge loan. But it's always important, especially when you're later in the cycle, which we aren't right now.
Yeah. So it just makes me think that maybe even a 7 or 10 year term on cycle two to maybe even ride through it, or maybe even give someone a loan assumption opportunity we've seen right now. If we want to exit from the property, it could be viable. We're seeing a lot of people who have, solid debt, pretty good basis, deals are bought in 2019 or maybe 2021 that are being sold for decent prices right now because there's assumable debt. So maybe that's something that we could, navigate if, rates get lower and then they raise rates again, that will, obviously increase cap rates. But if we could, rise above that with, an assumable loan or something of that nature to accommodate that, that could be enticing for the next, part of the cycle and whatnot. Speaking of which, and transitioning to the next topic, there's something I am actually very passionate about and very curious to know, which is how to get paid for your CapEx. So, where is value to add for value add deals? And the reason why I say this is we have an opportunity right now that we're looking at for a deal. And you want to learn more, you can reach out to me at my email, you know it, where someone put in a ton, and I mean a ton of money over what they should have on their CapEx plan, and they're not getting paid for it at all. In fact, they're losing a lot of money, and they're selling the deal for basically less or around for what they bought it for, about 5 years ago. So the question is, how do you get paid for value add? Because just because you throw a bunch of money at something means absolutely approximately nothing in returns to actually generating a better yield and a stronger ROI, and to really enhance your cash flow created on the property, right? So question is, how do you get paid right now for CapEx plans? And, different times of the cycle will probably yield differently too, right? With regards to where you put the money for that plan. So the question to you is, with your experience and everything going on right now, where do you get paid for CapEx, and where does it make sense to have a heavier plan and all kind of items under that umbrella?
So the simplest way to understand whether you're actually quote unquote getting paid for your CapEx, and let's break that. What does that mean? Because some people might hear that and they're just not understanding the concept. So, the concept is, if we want to make like a single family flipping analogy again, right? It's a very simple concept. If you buy a house, right, hopefully you buy, an ugly house on a good block, and you renovate the kitchen and the bathrooms, and before you know it, you've got the house back on the market and you're selling it for a premium, right? And your profit represents you're getting paid for your CapEx or your capital expenditures that allowed you to renovate the kitchen and the bathroom, etc. So, but what could happen is, let's say the house flipper in our example, let's say ran the numbers wrong. Let's say they thought that they could sell the house for $1 million, and so they bought it for 600 and they put 200,000 into it, so their basis is now 800. But let's say their math was off. They did the comps wrong or whatever it was, and they can't actually sell the property for $1 million. They can only sell it for 800. Well, they actually are breaking even and there's no profit for them, so they're not getting paid for all that work. So that concept, right, that's very easy to understand when you break it down like that. That concept applies the same exact way for multifamily. You could buy a property, put in all this work, and then in the end have really nothing to show for it. And the the issue there, the painful part about that is you could have bought a property that was stabilized, that didn't need repairs, and you could have gotten the same return, right? And so when we talk about alpha, what does alpha mean? Alpha means returns that are non-correlated to the market. So you're actually generating higher returns than what is normally available in the market. Well, there's two ways to actually achieve alpha. One way is to take the market level risk. So you just take regular old beta exposure, but you're able to achieve higher returns than beta. That would be alpha. The other way to generate alpha is you would take lower than market level risk and still achieve regular returns. So to make it a multifamily example, let's say you've got all these syndicators buying and value adding deals. They're buying deals, renovating all the units and leasing them out at higher rent, and they're generating, let's say, a 15% return. Well, that's a good deal. That's beta, let's say. Well, what if you could buy a newer vintage property, not have to take any risk or time to renovate the property at all, and still get a 15% return, right? It's the same return. So you could say, oh, well, it's just the same. Who cares? But the difference was you took much lower risk. So those are the two ways to achieve alpha, right? It's taking normal risk and getting higher returns, or taking below market risk and still getting that same return. So the reality is there's still people in the market that are championing value add, and they're looking for the next deal where they can buy and renovate the kitchens and new flooring, new paint, new bathrooms, and they're
Or
doing
they
all
can't
this work.
fathom the fact that a deal could get, outside normal returns with doing essentially very little to no value add plans associated, just managing and operating. You're just buying at the right point of what? The cycle, right?
It's a really good point. Yeah, it's we're humans, we're emotional creatures. We like pictures. And so when an investor sees a business plan and they see the before and after picture of an old, ugly kitchen, and then they see the new, nice, renovated one, their mind, it clicks in their mind. They instantly go, oh, that must be a good deal because that kitchen's getting transformed. That's a beautiful kitchen, right? But never mind the fact that you might be paying a compressed cap rate, which is implying that when you do the renovations, all you're doing is getting back to a market cap rate. So if the market cap rate's a six, well, you paid a five, then you do all your renovations, you raise rents, and now you're at a six. Or you could just buy the already renovated deal at a six today and take less risk and take less time, and it's just
Oh, for
easier.
5.5. Yeah. And get your cash flow coupled with the compression and you're good to go.
So it's maybe in some ways less sexy because it seems like, well, hey, this is too simple. Like how is this working, right? And so it's maybe not as straightforward, but that's why I started this answer with the most straightforward point is yield on cost. You have to analyze yield on cost to understand, are you being paid for this risk? Because if you can achieve the same yield on cost through a lower risk business plan, you should do the lower risk business plan, right? So you can't just look at the before and after pictures of the renovation scope. You have to look at the before and after picture of the cap rate to yield on cost equation.
Yeah. And it's funny, the picture of the 80s vintage, 70s vintage asset with heinous cabinets and bad flooring and roofs that need to be replaced to the updated, kitchen and whatnot may look really nice on LinkedIn to make a self-righteous post, but it may actually not help your wallet and dollar every single time. And I think anyone who, bought those really big forced appreciation deals on older stuff that's a little more risky, where cap rates were basically the same on that product as it was for a newer build, are getting slaughtered right now because naturally, the older deals are going to have wider caps as the market, trends in a negative direction for the next foreseeable couple of years, right? So that's the people that are going to get burned. Is sometimes the value add plan is not the best, and maybe you want to go cycle to cycle and kind of plan it. Maybe in a year from now, you want to, buy something that's a little bit more depressed, that needs a little more of a lift, that has maybe, occupancy issues that might require a bridge loan because agency debt doesn't size up to it with occupancy. You do that, you do the very, a riskier plan, and then you exchange that into a nicer, sexier asset that's stable and safe after you've had all those gains and taken your market alpha that you've created on the first deal, and then you're just going to ride it into market beta. But that over, a 5 to 10 year window will be a very successful and lucrative strategy. And then repeat the cycle, exchange that into a more risky deal when the market's changed, and so on and so forth. So that's not a bad strategy and implementation process.
So the where is it good to actually make a value add investment today would be the deal that is undermanaged and actually has issues to where you can buy at such a low price where if you put the work in, you're not actually putting the CapEx dollars in to raise rents. You're just putting CapEx dollars in to just save the property from going totally downhill. And that you can actually do very well with. Again, it's all about your basis. You have to buy in low enough to justify the risk. But that's kind of where the real meat of a value add opportunity is today. Because what we were seeing a couple years ago was perfectly good deals that were in good condition, fully occupied, well performing, and people were buying them and then doing full renovations on top of that, right? They were value adding the value added deal and just going to the next iteration of it and trying to push rents further. And it was working because the economy was growing and tenants could afford it. Today, tenants can't afford another rent increase the same way they could a few years ago, right? There's a constraint on affordability. And so when there's a constraint on affordability, you can't pursue, I mean, I can't say you can't, but it doesn't make as much sense to pursue business plans where you can raise rents further, right? So instead, and if you, I mean, look at the deals that we're buying right now. The business plans are almost kind of funny. It's like, wait, you're planning to raise rents by how much? Nothing? Oh, that's
Organic
interesting.
rent growth, what you already says.
Yeah, that doesn't make sense, right? Shouldn't you be aiming to raise rents? Well, guess what? You don't have to raise rents to still earn a great return. It's all
Also, I
about.
don't want to rely on a rent raising strategy right now over the next 2 years. God, no. Rents could soften, rents could drop, occupancy will likely go down across the board, especially as new supply is starting to hit these markets. Now, supply will stop being increased over the next probably 2 years from now, we're safe. So everything will likely be delivered in 2025. So 2024 and 2025. 2026, likely zero new supply coming up unanimously throughout, the nation, I would say, for the most part. But that said, it's concerning and relying upon getting a $300 rent pop unless maybe it's a smaller mom and pop owner does not seem very realistic.
Also, that mom and pop owner is no longer some ignorant mom and pop owner, right? Mom and pop owners are being advised now by national brokerage firms. And so that national brokerage firm knows the value of the property. So just because the rents are $300 below market doesn't mean they're going to sell the property at $300 for rent below market value, right? You're just going to actually pay a high value on the presumption that you're just going to raise those rents. And so it
And
doesn't
yeah,
matter.
so it's a double whammy because you're not really getting paid for their $300 there, but then you also have to go out, do the renovation plan, spend 10 grand per unit, and then get the $300 plus the extra bump that that renovation would give you, which maybe is $100. So now maybe
And
you're
get
at,
worse financing.
yeah, maybe talking about getting a $400 increase, not the business plan I want to be on at this point in the market cycle. So, and it kind of reminds me of our dear and good friends, and this is why I was smiling before, at Wall Street Oasis, who covered a couple of deals that some sponsors will go anonymous with, that, one guy bought it for like 19 million and then they sold it for like 42, and then the next group, bought it there
65.
and think they could sell it for 65, and the next group is going to buy it, think they're going to sell it for like 80. It's like, well, this deal not too long ago sold for X price and you're going to bring it here. Heck no, it doesn't make sense. There's just no way. What goes up must come down. And that deal, I think, and I don't have the exact specifics in front of me, I think you recall what I'm talking about, though, where it's like, yeah, this doesn't make sense, like just from and the nature of the deal. And you can't put lipstick on lipstick on lipstick on lipstick.
Right. And so cap rate compression or expansion can really stretch valuations, but you can only go so far away from fundamentals. And the fundamental constraint is affordability. And if we're talking about raising rents over and over again, the limit is a tenant's wallet. How much can a tenant pay for rent, right? And so that is what is really coming into play. So when thinking about a value add plan, you have to think about what is the affordability constraint here. And basically, what that means is what is my pro forma rent relative to the median household income? And, generally speaking, apartment, multifamily properties require that tenants make 3 times the rent. So if you have $1,000 a month in rent, that's $12,000 a year. They need to make $36,000 per year, right? That's not a very difficult constraint, right? 3 times for rent is not that tough. But so anyway, one point that comes to mind is finding ways to add value without actually stretching affordability. And one way that we've been rolling out across our portfolio and for new acquisitions as well is bulk internet. So bulk internet has really grown in popularity and in viability. And the way that we're the rationale behind it is basically the property buys internet in bulk and then resells it to tenants individually. And because we're buying it in bulk, we're able to get it for a very low price, very low price. And so we're able to resell the internet to the tenants at whatever price we set, but we set it at somewhere around market or even below market. And so by and large, all of our tenants are paying for internet and Wi-Fi anyway. So we're not actually adding more cost to their lives. We're just changing, rather than they go out and buy it from a third party provider, they're getting the internet from us. So the property is
Also,
able to
from a
generate
tenant
more
perspective,
revenue,
yeah,
right? The
from a tenant
property generates more revenue through a spread while
yeah.
not burdening affordability at all.
Yeah, from a tenant perspective, it's great because they can move in. It's more plug and play. They're getting likely because it's bulk a bigger discount on and on their internet service than they would be getting if they were to get it themselves. So it's truly a win-win process, and that's also it's an inelastic good. You're going to need internet regardless of the economy, and then we can buy it, make money off it, and the tenant can save. That's just a foolproof win-win-win. So that's one way we're doing kind of a CapEx plan. That doesn't really feel CapEx to me because it's not really anything that will be reflecting in the property itself. It's just more of the expense column in the T12 that will help us sell the property on the next point when we, dispose of it. But what are other arenas and ways in which, it's a solid place for CapEx currently? I mean, it sounds like you just want to buy the right deal at the right basis. But is there anything else that, would be useful in this current market, or is it all deal per deal basis, depending upon the age of the asset and also where it's located, depending upon the tenants?
Yeah, I mean, right now the risk curve is steepening, and so people now are avoiding risk, whereas before people were like, risk, no big deal, I'll buy it. So there wasn't really a price difference, to your point earlier, between A, B, and C class assets. But now we're seeing that price dispersion grow and become more so in line with normal conditions. And so what that means is there's actually a cap rate premium to be had from buying, let's just say if you could magically buy a Class C asset and then renovate it and turn it into a B asset, you would see the cap rate that that property is valued at go down, which increases the value of the property. So what that means is the very valuable place to be as far as your CapEx dollars is in renovating, not necessarily upgrading, but repairing a property and actually bringing it up a level from being, let's say, distressed or being in bad shape or having deferred maintenance and bringing it up to par. Because, like I said, there's the risk premium. And then one of the reasons for that risk premium is the differential between permanent financing and bridge financing. 2 years ago, there was no difference. In fact, bridge debt was cheaper than agency debt. So if a deal, let's say, had CapEx work or had below market occupancy, it didn't really hurt that property's ability to get financing. So then, therefore, the price didn't reflect that risk. Well, now it's there. And so now if you buy a deal that has below market occupancy and you need to actually, let's say, replace roofs or, invest into the parking lot and
Boilers and chillers,
boilers and chillers, fix siding, do the stuff that is not sexy, that
tab
doesn't
lock.
directly increase rent, that is actually a better way to spend CapEx dollars than saying, okay, well, the property's in great shape. I'm just going to renovate it to try to push rents, right? So that's where, for example, I mean, we'll be at Azul, one of our properties in Houston next week, where we're installing a pool. Well, are we going to magically raise rents because we're putting in a pool? No, not really, right? It's not a direct like, okay, now the kitchen's renovated, so you're going to pay $100 more. But this property, in a way, needs a pool, so we're giving the property what it needs to make sure that it's competitive in the market, but we're not burdening affordability through this renovation plan.
Right. And it's also going to help with retention and overall appeal and, just desire for the next buyer as well. So I love that premise. And, that is also a deal where we bought that on good fundamentals where there wasn't much of a value add deal to be done because that was a 2020 build, right? So is maybe just subbing out some stainless steel appliances. I remember it was something that tenants requested or, wanted was some stainless steel appliances and, us maybe adding a couple amenities to the property. But, our financials were really good going in, so we felt comfortable with that deal at any point of the cycle.
Yep. So yeah, so those are kind of the ways that we're approaching value add and breaking out of that mold that everyone got so accustomed to, which is, okay, you buy the deal, you renovate the interiors, you raise rents, and there's your good deal, right? There's other ways that a business plan can come together that will make a deal a good deal.
Yeah, and I think the biggest message I want to convey to people is be open-minded. Be open-minded about where the returns are coming from. But while you're being open-minded, also be skeptical at the same time about where the returns are coming from too. If the returns are coming from, hey, rents are already here and we need to get them $300 more because we're going to do X, Y, and Z, we'll be very cautious and conscientious and really actually challenge that sponsor, challenge the person who's pitching you on that deal, the capital partner and capital raiser, as to where comps to support your argument. Where does that stand? Where are the comparables? What is Yardi or in CoStar saying? The submarkets projections are going to be. Check also the supply coming to the market and where that is, right? So these are factors that are really important, especially, if there's a supply issue, what's going to happen? Well, rents are going to be softening and your rents are going to have to be, handicapped to where the new sexy asset's going to be. So be very conscientious about where the returns are coming from and keep an open mind there. All right, on to the next topic here. This is a question. Shout out Ryan and Alex on this one, who hopefully will be working with you guys in a deal coming up. We'll hopefully have space for you on something soon. But they had a question. Would love to hear your and Rob's thoughts on recession resilience, resistance of multifamily assets, especially given how long the yield curve has been inverted. So basically, why is multifamily recession resistant?
Okay, cool. So one interesting point that they made was consider the yield curve inversion. And so this is something that we touched on earlier, and I just kind of hinted at it. But for those that are not familiar with this concept, the yield curve is basically short-term bonds all the way up to long-term bonds. And in a healthy market, you would see a term premium. So the longer the term of the bonds, the higher the rate. And that's just the general concept in finance that if you're going to lend out money, the longer you're willing to lend it out for, you should demand a higher interest rate for that, right? That's just pretty simple economics. If I'm going to make a 1 year loan, I might charge an interest rate of X, but if I'm going to make a 10-year loan, I'm taking a lot of risk by waiting a long time for my payback, so I'm going to want to charge more than X for that loan. So that's the concept of a positive sloping yield curve. And so what happens late cycle is the yield curve actually inverts, which makes no sense. But what it means is short-term rates like SOFR or the 2-year US Treasury bond and versus the 10-year US Treasury bond, that relationship is inverted. So 2-year bonds are, let's say, 5%, and then 10-year bonds are 4%. So you're actually getting paid less interest to lend long term. And why would that ever be the case? Well, that would be the case when basically lenders are so nervous about the short-term fundamentals that they actually require a return premium for short-term lending, but they're more confident about the long-term outcome, so they're willing to lend long with less return. It's a weird dynamic and it usually doesn't last long. But funny enough, we've been in an inverted yield curve environment for a long, long time. I mean, I think 18 months at least now. And the yield curve inversion predicts recessions 100% of the time. So whenever the yield curve inverts, there's a recession. And on average, it's 18 months from the first inversion to the recession. So we're due for a recession any minute now. And that's why in their question, they go, all right, can you talk about multifamily's resistance or resilience to a recession in light of the fact that we're due any minute now for one? And so I think that so now that I've set the stage, we could talk about it. So with multifamily, I don't think that it's this magical asset class that is perfectly resistant to recessions. A lot of people like to go, like you said, and post on LinkedIn and go, yeah, multifamily is the best in the world. Everybody needs a place to live. So multifamily is the best in a recession. Everyone's going to still need a place to live. Well, that's not a good enough argument because as we know, the vicissitudes of the market are much more pernicious, to use some big words. The reality is
There's a
new
$10 word.
supply. I know. Yeah, new supply is hitting the market. That causes the supply and demand to be imbalanced. Rents can go down, occupancy can go down, collections can go down in a recession because as unemployment goes up, which that's pretty much the definition of a recession is unemployment going up, people have less money to pay for rent and they're going to likely go delinquent and not be able to pay rent and they're going to have to be evicted. So all these things are realities of a recession that really impact multifamily. So to go and say that multifamily is magic and it's bulletproof in the face of a recession is totally wrong. However, it is definitely stronger in a recession than many other asset classes. And that's uh, while that is very true, I just think that some people overdo this argument that, oh, multifamily is really great in a recession, right? Because you can totally lose money and underperform in multifamily. So with all that being said, I think macro, invest micro. And because you can, in a recession, invest into the right assets, which would mean in the right location where there's less supply, where there's less likely to be delinquency, right? What we want to do is we want to insulate ourselves against all of those negative things that happen in a recession. You're battling new supply risk, you're battling unemployment going up. So what you want to do is you want to be in a market where there isn't new supply. You want to be in a market where unemployment is going to stay strong. So where the jobs are more resilient to the recession itself, right? The multifamily is going to be more recession resistant if the jobs that underlie that multifamily market are more recession resistant, right? It all connects. So it's not all multifamily is created equal, right? We all know that. And so that's why, I mean, we don't need to, uh, constantly go over our investment strategy, but that's why we're in Texas. That's why we invest in suburban multifamily into this renter by necessity demographic where there's stickier tenant bases and there's a deep demand and a broad renter pool where we can cater to a wide demographic of people that really want and need our product. And it's not like a luxury good where they can just walk away from it. However, with that being said, when you talk about renters by necessity, you're talking about workforce housing. So you're talking about people that make less money. And, we all know the statistics. They're dire out there. I forget what it is, but it's something like half of all US households don't have $400 for an emergency, right? They wouldn't be able to afford a $400 emergency, right? That's workforce housing. So if anything slips, that rent is going to go delinquent. Whereas in a Class A property, if people are making 100, 150, 200, 250,000, those are renters, those are discretionary renters, right? They could potentially afford to own a home, but they're
That's the
renters.
next buyer is that person typically speaking.
Yeah,
Yeah.
they're renters by lifestyle. And
They're
if
living
they
in
have
New
a
York.
yes,
Yeah.
if they have a hiccup in their life, a crisis, an emergency, or a change in jobs, that's not going to all of a sudden mean that they're going to just go delinquent and stop paying rent, right? They care about their credit and they're going to likely have savings to be able to cover rent in the short term before they find a new job or whatever the case may be. So that is the difference between renters by necessity and renters by choice. So both, I would say, right, both are multifamily. So both are more so on the recession resistant side of things, more so than private equity, venture capital, stocks. But within multifamily itself, right, we're looking at the best strategies, asset classes, and geographies to position ourselves in the current environment. But I
Yeah.
mean, I think the funny thing about the question is it's like, hey, in light of the yield curve, what is multifamily's recession resistance? But I don't even care about the yield curve. I'm just looking at what we're seeing today on the ground. It already feels like recessionary, right? We already
It
kind of are
felt like a
feeling it.
recession for it's felt like it for a while. I can only speak to myself, but I feel as if my dollar, is not going as far as it was before, and I feel more pinched. I'm looking at, getting similar things and services, but my money is evaporating a lot quicker now than it was before. So that definitely feels a certain type of way, and I don't think I'm alone in that. And you and I are probably a little more recession resistant with what we do and the incomes that we make. We do well, but still, I'm feeling a little bit more pinched, and I'm not alone in that regard. Where I feel as if just hey, inflation is just really affecting many people, and that will hurt. But I will say the interesting thing currently right now is that with regards to job losses. Blue collar jobs and service jobs like that are really strong. So it's really more people that are like the analysts of real estate companies or work, as a financial advisor, mortgage brokers, real estate agents, stuff like that. They're kind of getting hit harder right now than, the plumbers or, the service person or, the garbage man, this, that, right? So it seems as if the more blue collar jobs are a little bit more resistant and haven't been as hit as hard yet, as much as, the more white collar, suit and tie folk.
That's a really, really good point. That's probably the best point of the whole show because unemployment is not dispersed equally across the labor market. And to your point, exactly, you totally nailed it. I think that in this coming recession, and we've already seen it, right? We've already seen the job losses occur in, well, first it was tech. Tech had a big recession and there was a lot of layoffs in
Was
tech.
in 2021, 2022. Like
Yeah.
those now it's kind of funny because I think Saks officially ended the tech, recession is over. So those jobs will probably start hiring again. Meta's doing really well. I'm sure all those jobs that were cut before just to kind of churn more revenue are going to be pumped back up again. So I think tech will actually have a nice bounce back now this year, which is good. So, to your point, the recession I feel is kind of in 2020, back into 2022 and 2023. If you look at sales, loans being originated and whatnot, not a lot going on, kind of the sign of slowdown and the slow churn of the market. But it seems as if that will start coming back now. So we'll see. But a thing that I thought about was, what's recession resistant? Well, workforce housing, which is people we're talking about here. They need a job, they need a place to live, and yes, rents may go up or down here or there. They still have to live somewhere, and they cannot produce workforce housing for an economically viable price, making it, recession resistant because replacement cost is so well above where your basis is for acquisitions going on, and you can't just build, willy nilly left and right. So, existing product value add, or, doing strategies that we talked about, which maybe it's adding bulk Wi-Fi and, select parking and smaller little items to the additional income section, while, getting good cash flow because they have a good basis. That's where it becomes recession resistant, in my opinion.
Yeah, and to examine an example of a recession, which was temporary, but we had a recession temporarily with COVID. And with COVID, what was interesting was the labor, the unemployment was in the blue collar space because those are the people that couldn't work from home. They couldn't work remotely. And all the white collar jobs, they could work remotely. And so that was a situation where the pain of a recession was dispersed more or more felt heavily in the blue collar segment rather than the white collar segment. And maybe now in this coming period of time, right, as we see unemployment spike, which it is predicted to do so modestly, perhaps it's going to be more so concentrated in white collar rather than blue collar. So, I mean, recessions all look a little different, and I think that just kind of paints the picture nicely about the current situation.
And it's interesting. I think people thought AI would take out a lot of the, blue collar jobs. In fact, if you do need your HVAC redone, if you do need your crawl place fixed, a robot is not going in there. A human is. It's more of, a lot of these admin jobs or analysts or kind of number crunching, analyzing jobs that are actually being replaced by AI. So that's kind of subbing in right now. So I'd be very curious to know what unemployment may or may not look like for the white collar space as AI is more widely spread and there's more tools and add-ons to either, hack productivity where maybe two people or three people could do what five were doing before. Naturally, there's a nice arbitrage and spread there. So that will probably have an effect to some extent. That's not to say the jobs won't be recreated and there won't be more growth and more of a individual versus corporatization of those jobs, where, someone might have their own little smaller shop and do it as a service as opposed to, a bigger company coming in. Maybe that will happen. I don't know, but it will be curious to see how AI does, kind of hurt the white collar space coming up. I have no predictions there. It's just kind of a thought.
Yeah, it's a good point. Another good point.
Yeah. So we're almost going to wrap up here because we have a webinar we need to do in about 24 minutes. We'll get to the Resi kind of structuring in the future. One thing I just want to speak on real quick. I listened to this book once more, was Rich Dad Poor Dad once more, and I just love that book. So we've talked about this a lot about what I should do with my own personal finances, and just want to make this a PSA to everyone. If you haven't read Rich Dad Poor Dad before, you really need to. If you haven't read it in a while, reread it. I think some of the principles really ring more true. And I was just analyzing my life, and I was like, wow, me buying another house and renting my house will only come with another set of burdens, more responsibility, more work that it's going to be done on my end. Then I have to refurnish my property because I'll probably turn it into a month-to-month rental or Airbnb. So it just makes me think, hey, that's actually not the right wise decision. I'm hearing Rich Dad in my head right now saying, no, that's probably not the best idea. But what is, and ironically, this market is more dislocated, is exactly what we're doing here on this show and exactly what we do, which is multifamily investments and get, items on the asset column, which is, of course, investing in these deals. So I just had, another paradigm switch once more, away from the single family space and more into the passive space, which is, of course, investing in our opportunities, eating more of our cooking, as you like to say. So I just felt very inspired and, my brain was really turning and just thinking about, wow, if I can just, really go all in for these next probably 3-4 years, as the market is shifting into the multifamily space, which you very well say is more dislocated and is for sure with regards to where that market is opposed to the housing, will be set up very well. So that was just kind of my thought there and, reshifting and more alignment into what we're doing here. But I just want to do a PSA to Robert Kiyosaki. Shout out to him. And that book is just so incredible.
Yeah, no, you're making me want to go back because the funny thing about that book is it's digestible by a 12-year-old. A 12-year-old could read that and understand the concepts fully, but I also think that it would be very interesting for me to go back and read it for me now because I don't think I've read it in at least 10 years. So
Wow.
it would be interesting to revisit the concepts and see, if I look at it from any new perspectives.
I really do. So I think you likely will too. It is, to your point, exactly the most digestible book. And I've kind of had this thought here, which is just like a relationship. So we want to go very deep in. I want to go deep with about 12 books. Okay. I don't need to read a billion books, but maybe every single year. And I think this is the thought that I'm going to move forward with and going to do. So I'm actually going to state it right here, right now. A book a month, but the same book every single month forever. So I can do maybe other books on top of this, but every single year around New Year's, around the Christmas time, I'm going to re-listen to Rich Dad Poor Dad once more. And then I got to find a book in February. I'm thinking Sell or Be Sold would actually be a good one by Grant Cardone. I don't advocate everything about Grant Cardone, but as a salesperson and having listened to that book, it really is a great one. So I think I'm going to do Sell or Be Sold for February. So maybe I'll have to do a little Craig Book Club special.
I like
But
that.
yeah,
I
maybe we'll
like
have to
that.
do that and we'll collectively do a book together. That could be a fun little thing. And maybe for the podcast listeners, we can do that too. So we'll think about that. But just really want to once more shout out Rich Dad Poor Dad and the incredible, digestible and, evergreen content that that book is and just the gift that keeps on giving, which is that book. So I just want to really shout out that. And as I said, if you haven't listened to it, please do because it is so enlightening.
Yeah, we should definitely next episode come back with some of the most important books recommendations, right? Like you said, there's hundreds of good books out there, but what are the books that make sense to just keep going back to? And then, yeah, it would be fun to actually just let people know, hey, this week we're reading and listening to this book. And then we can,
Book club.
yeah, if anyone has recommendations, shoot us a note and then we can kind of just get going from there because yeah, I used to do a ton more reading than I do now. Different times, learning versus executing and things like that, growing and everything. But yeah, no, it's always good to be learning and reading and stuff. And as far as goals, I know you put that, you're giving that PSA as far as goals. Last night, I came home. As right as I came home, I put my phone down in the kitchen and I retired to my bedroom. I did not bring my phone into my bed. Instead, I picked up the Kindle and I read for a while, got some good sleep. This morning, I got up, I stood in front of my red light panel and I meditated while I took in the red lights. So killing
He's
many
holistic,
birds.
folks.
Yeah.
He's looking for his wife and he's holistic. You love to see it. That's how you
Very,
know 2024 is going to the moon.
very healthy, very healthy. So tonight will hopefully be another night with no phone in bed, no blue light, and a good night's sleep.
Yeah. So Rich Dad Poor Dad, if you want to get on the book club train, I'm going to call it right now. This is a new initiative for the podcast and just generally moving forward so we can all kind of cohesively and collectively do something together. Please read Rich Dad Poor Dad in January if you haven't done so. Hopefully Rob will do so as well. And then I think next week we'll have to have a book of the month for February that we'll discuss in March. But I'm actually thinking here while I'm on it, Seller Be Sold is definitely something that I would like to, kind of go into because there's really good philosophies there. And maybe I'll make some notes as we go through it. Maybe you'll make some notes as well. And we can collectively do a book together, and we can share it with our friends, of course, to create larger discussion and enrich each other. But I also want to make sure that we can do year two books for 1 month because it's about 1 month worth of reading or so. So you can find those books, both those books on Audible. So of course, Rob Sue Books. You can Google them. You actually see the cover in the background if you want to pull them up real quick in your office. Yeah, maybe we'll do that actually for January is both of your books to maybe drive some more sales to those books, of course, but just to go through them as obviously we're deep in there. And those two places for investing, I don't think there's a more dislocated market, as you would say, than the multifamily market. So I think really learning the principles that you have so well outlined in your book could be useful. So maybe January or December is, Rich Dad Poor Dad month. January is Rob's two books, and maybe February is, Sell or Be Sold or something of that nature. I don't know. We'll figure it out. But yeah, it gets me excited and gets my juices flowing.
Very good.
Cool. Well, with that said, thank you so much. We'll be in Texas next week. We have the Aspire webinar in approximately 18 minutes, so we're very excited about that. If you have any questions about that deal, it is a 506C. Be more than happy to answer any questions if you're an LP or a capital raising partner to see if we have any room left in that deal. Ryan and Alex, thank you so much for the question. Keep it coming. And if anyone has any mailbag questions, obviously email me. My email is craig@lscre.com. We look forward to seeing you on the next episode. Peace.